Good evening, everyone. Welcome to the buying or refinancing property in Australia webinar. We will be discussing mortgage finance and tax tips for Australian expats and overseas residents. Right. So today's agenda, we'll be going with speaker introductions. It'll just be myself and Pao. Then we'll be going to our first topic, which is Australian expat mortgage finance, the lending restrictions and interest rates. Then followed by the tax topic, which is mainly covering tax residency, proposed new rules, and property tax issues from a non-resident perspective. And then if we have any questions and answers, we'll get to those at the end of the webinar. Some housekeeping: this session will be recorded, and the slides and the webinar itself will be shared after the webinar, probably tomorrow. Please ask as many questions as you like in the chat box section and Q&A. And you know what? We might just answer them as we go along as well. We'll see. So without further ado, let's get started. My name is Ben Wong. I'm the co-founder and mortgage broker at Odin Mortgage. And Pao Lam, he is the director of taxation at Odin Tax. So Odin Mortgage and Odin Tax, we are an Australian company currently based in Hong Kong, but we have an office in Singapore and Australia as well. And we deal primarily, specifically with Australian expats and overseas residents who are looking to purchase, refinance Australian property, or they have Australian properties and they're required to lodge a tax return every year. So in regards to Australian lending, I'll start off by going over a brief history over the last 10 years. To give you guys an idea of how it's developed. So back in 2012, so a decade ago, the lending policies for Australian expats or just overseas residents in general was very easy. The credit policies were very relaxed, and there was really no difference from borrowing in Australia or borrowing outside of Australia. It was actually quite easy, and you did not need any specialist knowledge to obtain a loan. They were just giving it out freely. Then 2016-17, we saw over-regulation from the regulators, APRA, in Australia, mainly after the influx of foreign investments from China and abroad. So at one point, there was billions and billions of dollars just pouring in, snapping up real estate, both established and new, from overseas, which was inflating house prices. And at that point in time, I think 2016, towards the end of it, they also did some audits across the 4 major banks, and they did uncover billion dollars worth of fraudulent applications. And based on all of that, they did clamp down harshly on the lending for anyone living overseas. So it was a pretty harsh time at that time. And we had the 4 major banks, CBA, ANZ, Westpac, NAB, who did have lending branches in Singapore and Hong Kong, and they were established for close to a decade in Asia, and they all closed down and or sold their banks off to Singapore banks or other banks, and not looking to come back anytime soon. 2018-21, the lending credit policies for people living overseas have stabilized, but then there is now a clear distinction between if you're living in Australia versus if you're living overseas and how they calculate your income. So all of that is good because it now allows us to be able to give concrete and advice to you guys, so you know exactly how much you could borrow. But that knowledge required to differentiate is now more important than ever. Fast forward to this year, 2022, we're just starting to see rate increases month after month, as you are in the US as well, on the back of global political and economic uncertainty. And that does affect borrowing capacity. So as rates go up, your mortgage repayments, both current and proposed repayments do all go up, and that does affect how much you can borrow. And I will share all these slides, charts in the slides following. So in terms of what is still possible from an Australian lending perspective, you can still borrow up to 80% of the purchase price, even up to 90% with lender's mortgage insurance, which is not common. So with the lender's mortgage insurance, there's only 2 banks, Commonwealth Bank and HSBC. They'll still look at doing that. You can borrow up to 30-year loan term, regardless of age. So you could be 80, 90 years old and still get up to a 30-year loan term, provided you can show strong positive cash flow. And there's no early repayment penalties in Australia by law. So if you took out a mortgage today and paid it out next month, you're not going to get whacked with that 2-3% early repayment penalty like you would in other countries, UK, Singapore, Hong Kong. So what's been happening in 2022? Mainly all negatives, to be honest. So the banks have all increased their assessment rate to 7.5%. And so the assessment rate is just the interest rate that they use to calculate your existing and proposed debt. So if you had a mortgage, an overseas mortgage, that's maybe only 2 to 3%. Or if you had an Australian mortgage currently that's you're only paying 4% or 5% on, they're still going to use 7.5 to 8% to calculate that repayment. And that's just to factor in a buffer for any future rate increases. So effectively, you know, we're calculating double interest there when calculating your borrowing capacity. They've also lowered the debt to income ratio to 6 times. And I'll explain more in the next slide about this, but essentially that just means you borrow less again. And on the back of increasing interest rates, we're starting to see the fixed rates have now overtaken variable rates. So when you get a mortgage in Australia, you know, you have the option to have a fixed rate or a variable rate, you know, the floating rate. And for the past 3 years, variable rates were higher than fixed rates, but now fixed rates have overtaken that. And I'll show you more of that in a chart. Lastly, we have now fewer lending options. So earlier this year in 2022, I'll share a couple of stories. So earlier this year in 2022, we had a really good bank for expats, even in the US, actually, pretty good one, Kudos Bank. They would lend up to 80% loan to value ratio, and they would allow us to use 100% of US income, because a lot of the banks do discount foreign income when assessing. So they were a really great bank for us, but halfway through the year, they pulled out of lending to expats entirely. And that's because the regulators have ascertained that their loan book was too heavily skewed to expats and overseas residents. We're definitely partly to blame for that. And Heritage Bank, so with Heritage Bank, we met with them a month or two ago with the head of mortgage lending at Heritage Bank, and they advised us that the amount of deals that we were sending them was skewing their loan books as well, to the point that they had to reduce the loan to value ratio from 80% to 70%. So now they only lend up to a maximum of 70%, but they were also a really great bank. They had really generous credit policies for people living overseas. So Kudos and Heritage Banks they're not massive banks, you know, they're not big four, but they rank around 15th to 20th largest bank in Australia. And in Australia, there's actually over 40, 50 different lenders lending for mortgages. So there's a lot of banks, credit unions, financial institutions. So that's where Kudos and Heritage are ranking there. So in regards to that debt to income ratio that I was talking about earlier, so on this chart, maybe I'll just explain what debt to income ratio is. It's pretty much your household debt divided by household income. So debt is just mortgages and credit cards or personal loans. And income is just, you know, your employment income or rental income. So I'll give you an example. If you have debt of around 1 million Australian dollars and your household income is converted to around 200,000, this is gross income, by the way, 200,000 gross. So 1 million divided by 200,000 is 5. So if you're below 6, you're good. And if you're 6 or above, then they won't lend to you. So in that example, 5, we're good. So this chart here just shows the percentage of borrowers that are above the 6 times DTI. So as you can see, since 2019, it was flatlining around 15%, and it's increased to, you know, even a quarter of all borrowers above 6. So the regulators have implemented that to the banks, and then now that has now been coming down 22, and it'll keep dropping. So essentially, the regulators just don't want borrowers to be highly leveraged at this point in time on the back of increasing interest rates. Okay, they want to curb mortgage, risky mortgage lending, protect borrowers against defaulting. Yeah. This chart here shows the housing interest rates. So the Australians, this is the average interest rates that Australians are paying right now on their current mortgage in or outside of Australia. So this chart only has data up into July 2022. But since July 2022, we had August rate increase of 0.5%, and then September 0.5% increase again. So there's already been an increase of 1% since this chart. So you just have to add on 1% onto these figures here. So variable rate, the average Aussie is paying around 4.86% right now. And then you can just add on 1% on these as well. So as you can see, for the past few years, variable rates, as I was saying, was higher than fixed rates. And then the variable rates did start to go up as the Central Bank of Australia was increasing rates. So they just followed the Central Bank of Australia. You know, when they go up 0.25%, it goes up 0.25, goes up 0.5, they go up 0.5. But fixed rates went up even higher than the central bank rates. And that is because the fixed rates are set by the banks. So the banks in Australia are just forecasting that rates were going to increase at a higher rate, 2023, 2024, they have to factor those rates in. So the fixed rates could be a proxy. You could use it as a proxy of where the banks think that rates are going to go. So probably around the 5, maybe even 6% mark, probably where they're going to go for in terms of a rate that you would get from the bank for a mortgage. So at the moment, I can tell you, we can get fixed rates from 4.69% and variable rates from 4.34%. So if you have a mortgage currently and you're paying 5% or over, then definitely come speak to us and we can refinance you to a much lower rate product. Okay. So I had a question here for Doug. Does DTI 6 vary between different tiers of lenders? So yes, it does. So the DTI here of 6, it depends on the lenders, it does. So some banks do offer a threshold of 8 DTI or 7 DTI, but I'll tell you the majority of banks right now are using 6. And it also depends on the purpose as well. If it's an owner occupier or if it's an investment property, then they'll use different DTIs as well. But just as a rule of thumb, it's 6. RBA cash rate target. So this chart here is just showing the interest rates set by the Reserve Bank of Australia, the central bank. So they have lifted the cash rate now to 2.35% in September 2022. The Reserve Bank of Australia, they meet every first Tuesday of every month to discuss rate changes. So the next one will be probably next week, I think, possibly next week, yeah, to discuss. And it's very likely they'll probably increase the cash rate by another 0.5%. So I know in the US, they've been increasing by 75 basis points, but Australia has just always been constantly increasing by 50 basis points. And that's just because the inflation rate in Australia wasn't as high as the US, I think 1 or 2% lower. Okay, so the whole thing with increasing cash rates or controlling, increasing, decreasing is always to do with inflation rate. So the Reserve Bank of Australia has a target of between 2 to 3% inflation. And they're forecasting that inflation is peaking at 7.75% in 2022, and then which will drop to 4% next year, and then it will hit the target of 3% in 2024. So hopefully we'll see stabilization in rates by the end of this year or maybe early next, because there is a lag factor when it comes to rates. You increase the rates, and then several months later, inflation does start to dip. So they said that they could increase rates in the coming months, but it's not a certainty. But as long as the US keeps increasing rates, I think Australia is just going to have to follow as well in that respect. So on that chart here, you'll see that we have the 10, 20, and 30-year average for the cash rate. So if we did take 10 steps back, we are still well below the 20 and 30-year average and still below the 10-year average. So while everyone likes low interest rates, it's still not too bad from that perspective in terms of rates, because we were at a record low 0.1 cash rate, in 2020, 2021, and you couldn't go much lower than that at that point. So we're now at 2.3. Now I just want to talk about my last.
Probably we'll just answer this question real quick.
Yeah.
Doug has asked that.
No, I already answered that question. Yeah,
sorry.
I answered that question on DTI already. So, so I want to talk about this last topic here, which is what are the banks looking at when they're thinking about lending you money? It's mainly two main factors, but there are actually many variables. So the first factor is just your deposit, how much cash you have. And then the second main factor is your income after expenses and tax, your disposable net income. So in terms of your deposit, I'll share with you an example. So if you're looking to buy a property for $1 million, and as I said, you can borrow up to 80%, which is $800,000. You still need to come up with the stamp duty, which is around 5% of the purchase price. So $50,000, you would need to come up with $250,000. So you need to prove this to the bank. And so you can just prove that by means of bank savings, cash in bank, or your share portfolio, or even a cash gift from your relatives. Or if you have Australian properties that has equity in it, we can look to top up, the loan or take out a cash out against those properties, and that can form your deposit. So altogether, that's not quite straightforward. The one that catches out most people is the income, because the banks are quite harsh. So as I was saying before, there's over 40, 50 different lenders in Australia, but the vast majority of them will not lend to people living overseas or earning US dollars. So then out of the ones that do, let's say there's several banks that do, we can split this to lenient banks, like the expat friendly banks, and then just the standard ones. Okay. And you see the difference between the two. So with the standard bank, they would discount your US dollars straight off by 20%. So if I use an example here, whereby you're earning, 12,500 gross per month, we're only looking at 10,000 now per month. And they would factor Australian tax rates. So they'll look at the Aussie tax rate or the US tax rate, and whichever one is higher for your income at that perspective, they will use the higher of the income. Okay. Let's say effective Australian tax rate of 30%, where we're left with 7,000 per month. And let's say you're paying rent of 3,500 per month, then you're left with 3,500, and then living expenses of 2,000 US per month. We're left with 1,500 disposable income, and that could only lend you up to 300,000 Australian dollars. So with a more expat-friendly bank, they wouldn't discount your US dollars at all. We would be able to use the full 12,500. And then, actually, this is not quite right. I haven't changed that figure, 15%. I think it's around 30% as well. So US tax rates will be the same as Australia. So it would be 8,750. And then the rental expense will be the same, 3.5 thousand. And then living expenses would be same. So these figures here, before I was doing just a Hong Kong webinar just yesterday. So I had 15% here in that. But here, I did use all the same here, 3,500 and 2,000 US. So then you would be left with, in this scenario, you'll be left with 3,250 US disposable income, and you could borrow 700,000 Australian dollars. So there is quite a big difference with the banks. And depending on the banks, they're not just like this or this. There's a lot of the banks in the middle as well, and some banks even more friendly than this. And so at the end of the day, different expat policies across banks can mean sometimes between a 2x to 4x difference in terms of your borrowing. So I suppose that's where we come in as Odin Mortgage, whereby we know all the bank's policies inside out from an expat perspective, and be able to advise you which banks can do what and exactly how much you can borrow, and be able to guide you exactly. I suppose it's just mainly to give you confidence of your borrowing capacity in this uncertain and volatile market. So that does end my slide. And so I'll be passing over to Pao, who will be checking. Maybe before that, I'll answer a question from Paul, which is like, can you include passive income dividends as part of your total income as he's retired? So yes, you can. So a lot of banks, as you can see here, it's all about cash flow, right? So the banks really, so there's two types of banks actually. So I had a question yesterday, which was, can banks look at assets? So unfortunately, for the majority of, pretty much all the banks in Australia, they just care about cash flow. They care about income more than anything, to calculate how much you can borrow. but we do deal with the banks in Singapore and Hong Kong as well. So the banks in Singapore will allow assets. So if you had $10 million in the bank, for example, they have a formula to convert that 10 million cash into cash flow, and then they can then calculate how much you can borrow based off on assets. But in terms of Australian banks, they only care about cash flow. So dividends would have to be strong. You would have to show 2 years of dividends, and it would have to be a lot. And then we can look at Australian rental income as well. So we have done lending whereby someone was unemployed, but they had 7 investment properties in Australia generating very strong positive cash flow, and we could use that to help him borrow for that 8th investment property. But you would need very strong passive income. I guess, later we can have a chat and see whether that's possible for you. Okay. How did you, I'll answer one more question and then we can go into tax. Expat looks nice. What is the ability and fees to pay off the loan? As I was saying, there's no penalties to in Australia by law, so you could pay it out tomorrow. So the only fee that you have to pay is just the admin fee. The admin fees for the banks are around 300 Aussie dollars that you pay, and then you would have to pay $200 to the government to remove that bank from the title. Because right now we know when you do a title search on your property, you'll say it is the mortgagee is Commonwealth Bank of Australia. They'll have to remove that. It's like $200 to do that. So it's not too much. Okay, so Pao, you can share your screen and take over.
Yeah, thanks, Ben. Hello, good evening, everyone. So my name is Pao.
I think I still see my screen. I'll stop sharing my screen. Okay, then you can share yours.
Can you see my screen now?
Yes.
Yep. So my name is Pao. I work with Odin Tech. So we are the sister company of Odin Mortgage. So today I'll quickly go through with you, say a bit of the Australian tax as a non-resident again, because I believe most of you are living in the States. A few things I want to talk about today is first of all, the current Australian tax residencies rules and how they apply to you, and how they see it as majority view as a tax non-residents. Few things we'll look into is few tests, resize tests, domicile, and then the 183 days tax. So for the resize tax, what they will look into is, are you actually living in Australia or are you living somewhere abroad, in a permanent basis? So they'll look into whether you physically in Australia, what about your families? Is your wife, your kids with you in the state, or are they living separately with you in Australia? So, and they also look into your working environment, your social ties, everything that to kind of look into and determine whether you are a tax resident or you are a tax non-resident in Australia. I think for majority of you, if you're living in the state in a permanent basis, then yeah, that would kind of already be enough to deem you that as a non-resident of Australia. However, they will also look into the domicile test. Where is your place of domicile? Where is your place of permanent place of abode? If you can establish that you are actually living in the state, for example, by showing that you have a long-term lease in the state, that will also be sufficient to prove that you have established the permanent place of abode overseas. The straightforward way to look into is the 183 days test, where they will look into, are you how long did you stay in Australia in the financial year? So if you stay more than 183 days, it's very clear. Well, I'll say more than 90% of chance that the tax office will see you as a tax resident. But if not, but I wouldn't say like if you stay below 183 days, that will also deem you as a non-resident, because we also need to look into the resize tax, the domicile tax. But in general, it is safe to say that if you stay not more than 183 days in Australia, that you should be treated as a tax non-resident. So this is what the current tax rules are. So these established in about 60, 70 years ago. So they are not really modern now. And sometimes it's got confused because it's hard to determine in some of these rules. So what the government now, they are proposing this is from the last government that they brought in 2021 in that year's budget. So the proposed changes are, first of all, why they wanted to make the changes really to blend into the modern world that majority of people travels during their life. So you could be 10 years in Australia, 10 years in the state, and maybe 10 years in the UK. So they want to make things easier to determine whether are you a tax resident, should you tax you for your foreign income or not. And these rules are just to make things that, especially for the expats, easier to determine into each one's circumstances, instead of you need to probably lodge a private ruling and talk to the office and try to fight with them. So these will then make things easier, all the terms easier to understand and standardize the procedures. So the difference between now and then, the 183 days rule still applies, still there. So, but it become more bright line. So as long as you stay in Australia for 183 days, it's octo that you became a tax resident in Australia. So instead of like previously, you can try to argue even you stay more than 103 days because of some reasons, especially during the COVID time last year, during the hardship. A lot of the expats, they got stuck in Australia. So ATO did come up with some sort of exceptions. If you can show that you were in Australia during that 1 to 2 years, just because of COVID and they couldn't get out from Australia especially during the time that when the border was closed in Australia, so you can't get out. So they will still make a special consideration to deem you as a tax non-resident, even you stayed more than 183 days in Australia. But it will become a bright light test in the future. If you hit that mark 183 days, I don't think there will be any exception that the tax office will look into it. And more than that, if you didn't say, for example, you didn't stay more than 183 days, they will then look into the factor test, which is for people who stayed more than 45 days in a financial year in Australia. They would use the factor test to determine whether you are a tax resident or not. So for the factor tax, they look into 4 things. And first one is, do you have the right to reside in Australia? If you're an Australian expat, citizen, or a permanent resident, then yes, you do have the right to live in Australia. So this is like basically a tick for everyone if you hold a passport or a PR visa. And also, do you have the ability to access Australian accommodations? What the accommodation means is, do you have a property in Australia? Even that property is now being rented, but as long as you have the right to take it back for you to live in the future, there will also be a tick in this taxes as well. The third one is they will look into your families. Is your wife, your husband, or your kids living separately in Australia? So previously, we can still try to argue that you or your families or kids are separate. So it kind of looked at differently into your personal level. But now the tax office will look into as a household more likely. So as long as you have your wife or husband, your kids, they are living in Australia studying for whatever reasons, that will also be a take in that family taxes as well. And the last one is the employment and economic connections. Do you have employment in Australia working for, say, an Australian company, or are you running a business in Australia but just simply living overseas? So all these taxes will also be looked into as well. So as long as you satisfy any 2 out of the 4 taxes and you stay more than 45 days in Australia during the financial year, they will then deem you as a tax resident in Australia. So that has been very harsh compared to the current rule, because the current rule is more likely the 183 days first. But now is 1.5 months. So that means if you spend a big longer holiday in Australia for say Christmas, a month in Christmas, and then maybe another summertime for another 20 days, and you add up to be like staying in Australia for 50. In the current rule, you're still fine, but with this proposed changes, then very likely they will see you as tax residents, which means your overseas income, the income that you earn in the state, will also need to be included in your Australian tax return. Even though there's double tax agreement between the state and Australia, you might still need to pay for the margin between the Australian tax rate and the US tax rates for your income earned in the state. So that's a big change. So far we don't know where at the end of the day whether this will be passed it or not, because this has been put on hold for more than a year now. The last update I think was like last August, but no movement so far we see from the current government. But also we don't think they were gonna pull it out, but just maybe extend into the next financial year for them to look into it. Yeah, we might be able to share more details once the government has announced it, whether this will become law or not, or whether there might be some amendments to it.
Yeah, so my understanding is it hasn't even passed legislation yet, right? And it's becoming something just like the negative gearing topic. So for many, many years now, they just keep talking about potentially, was it the Labour government potentially talking about removing negative gearing benefits? And they bring it every, election cycle, and it doesn't really get anywhere. And so same thing with this 45-day rule. It hasn't passed legislation yet. And even when it does, it would only take effect in the next financial year. So I think we're probably still in early days, right? For this.
Yeah, maybe potentially just prepare for this, because this will really affect how you arrange your time back in Australia. We wouldn't be that freely to spend.
Would you prepare for this though? Like if this thing was only going to take effect, if it passes legislation, it doesn't come into effect like until the next financial year. I think you have a lot of time to prepare.
Yeah.
You have like at least a 1 year's heads up that this thing would be coming around. So then you can make preparations then. But and to that point in time, I don't think you would worry about this yet, right? You wouldn't make like drastic changes. But I guess if there is big, significant life decisions that would play out over the next decade, sure, maybe you want to look into those. But otherwise, you probably wait into it has at least got some serious discussion and pass legislation before doing anything drastic. That's my thought on that.
Yeah, that's correct. So we'll see how the changes will come up with. We'll share more info after that. So for now, as tax non-residents, and especially if you're living in the state of Australia, in this United States, as tax non-residents, you still need to lodge the Australian tax returns regardless if you have received the following income in Australia. It could be a part-time income or a full-time income that you work with for an Australian company and they pay your salary, or you do have rental properties, investment properties in Australia, and you are getting rental income or bank interest. This is something that a lot of people will miss is if you have money in the Australian bank account, you usually also receive bank interest. And that is some sort of income that you also need to report in Australia. And also for dividends, but it's only limited to the unfranked dividends. If it's fully franked, which means 30% of the tax has been paid, then you don't need to report that again. And also the capital gains on sales of Australian properties. This is a bit tricky. Majority of that will only look into the investment properties or in general, Australian properties in general, but not including Australian shares. So for Australian shares and as a tax non-residents, they are capital gain free. So if you have been trading, buying shares, especially Australian shares, just bear in mind that is you don't pay tax on the gains you make again, but you couldn't claim the losses if you make a loss on share trading. And the hacks, if you do have a hacks in Australia that haven't been paid it off, you also need to report your state income, your foreign income, and to calculate how much you need to repay of that hacks amounts. So this is something now the tax office, the Australian government would like to know and want you to pay it off as soon as possible by looking into your foreign income and make the calculations. Last of all, one big thing I think that is quite important, which is the recent Queensland land tax reform. This is something just came up, well, the rule has been passed last year, but it's been very talked a lot recently on the news and among the Queensland state people. So Queensland will now become the first state to introduce interstate land tax starting next July. Because currently every state will only tax land value for the land they have, people have land in that state. The Queensland government is trying to grab more tax by looking into your interstate land value. Say, for example, you have a property in Sydney, in Melbourne, or say in Perth. They'll also be looked at in and acted into your Queensland bill, land tax bill. For now, there's a threshold where Queensland is, for individual, is 600,000, which means as long as your combined land value is not over 600K, you will not require to pay any of the land tax. But once you hit over the threshold, you will start to get being charged. So a quick sample here, as of now, and what happens after this new change came in next year. Say if you own a property in Victoria with a land value of about $1 million, which means you have to pay land tax in Victoria for $2,975. And you also have a property in Queensland, which is also valued at $1 million land value. And the land tax is a bit higher in Queensland because of the different thresholds and rates, and you pay $4,500. So this is what you are paying right now. Combined, it would be close to 8,000, 7,500 roughly. But then the change next year, when the Queensland government looked into your combined, well, national-wide land value, you still pay the same in Victoria, $2,975 for that 1 million land value. But then the Queensland government would charge you 21,000, which is almost like triple of what you originally was paying, more than triple, because they now also added your Victoria 1 million land value into their calculations. And that is way above the 600,000 threshold. So this is something that we see that either the government is trying to stop you, if you're people in Queensland, they're trying to stop you from investing into other states, kind of lock the money into Queensland, because if you again invest in Queensland, then they will try and charge you additional tax in land tax for other states' properties. Or also encourage people from other states to invest into Queensland, because again, you kind of expose yourself for your foreign, for your other states' properties into the Queensland land tax calculations. This has been passed, this has been formal, so I don't think much that we can do now. Well, there's been a lot of objections going on, but it's unlikely the Queensland government will listen up and
just so Pao, like Doug wrote here that he heard the Queensland Premier put the plug on the land tax changes this morning. So I don't know if that's the thing. I don't know, like you might want to look into that after.
Right, so yeah, there's something yeah, if this morning.
Are you saying it's passed? You saying it's passed already, or
it has been passed?
Okay.
But it's been a lot of objections, a lot of noises coming up. So
Right.
potentially they might look into it. So we'll have a look into
Well, you
it.
look into it, and then like when we send the slides and the recording tomorrow, maybe you want to write something about
Yep, if
clarification
I'll
on
look
that.
into it. If that has been amended or for some reasons changes on the slides as well. So that's about it on the on this Australian tax. And for ducks, yep, so about has been put it up. So I'll look into that, make changes to the slide if that's the thing. Otherwise, that is the wrap up of today's presentation.
All right, so guys, if you have any questions, you can ask now. Otherwise, we'll call it. So, okay, he's saying look into WA today for the
Yep,
photo
thanks,
reference.
Doc. Yep, I'll look into that.
Okay. All right. So, hope you all found that useful regarding Australian mortgage finance and tax. And like I said, we'll be sending the recording and the slides tomorrow. And so you can have a look, and also for the people who couldn't attend today. So we're Odin Mortgage, Odin Tax, and I guess have a good evening. Thanks. Thanks, guys.
You guys.
Bye.